Hi everyone, it's Lien here at BK Forex. In my weekly videos, we talk a lot about the importance of having a good trading strategy, making sure that fundamentals, technicals, and market sentiment is on your side so that we can filter and select only the best trades, the trades with the highest probabilities of success. Now, identifying the best points of entry is obviously very important, but trading pros know that the exits is just, if not even more important than the entries. When I started my trading career on the Forex market making desk at JP Morgan, which looked very much like this picture here, I was the only woman on the desk at 1999. I sat between two very experienced traders, TD and Masa. I remember one day they were both in dollar-yen positions at the same time. TD was prop trading dollar-yen to the short side, and Masa, who was the dollar-yen market maker, had a customer sell him dollar-yen, which made him effectively long. At the end of the day, both of these traders banked profits on dollar-yen. How did this happen? Masa held his long dollar-yen position for a quick 10-pip profit. It was a hefty exposure and he didn't want to stay in it for long. TD had a smaller position, so he rode the 10-pip move against him and booked a profit of 50 pips by the end of the day. Small moves, but when the smallest position on the desk is $5 million, every pip can make a very large impact on the PML. In the case of Masa and TD, their profits had little to do with their entries because they were long and short at the same time, right? It had everything to do with their exits and their trade management. To really drill in this point, I want you to imagine that you're on an airplane flying from New York to Bora Bora. Why not dream a little if we're imagining here? Would you rather the pilot of your plane get the takeoff or the landing right? Considering that the majority of airplane accidents happen on takeoff or landing, I'm sure every single one of you watching this video will pray that the flight has a smooth takeoff and landing and the pilot gets both right. Of course, there's a lot more at stake when a pilot flies a plane than when we put on a trade, but in both cases, the exits are just as important as the entries, because if you botch the landing or the exit, you're in trouble. There are a number of different techniques to exit a trade, and in my experience, the best way to manage a Forex trade is to have a short and long target. A short target is what I consider an easily achievable exit point, like 20 to 30 pips, for example, on a standard day trade, and 40 to 100 pips on a swing trade. It can oftentimes be very difficult to get 40 to 100 pips on a day trade, which may be what you're trying to do if you're trying to manage a perfect 2-to-1 risk-reward ratio. A long trade should be much bigger, anywhere between 40 to 60 pips on a day trade or 100 to 300 pips on the swing trade. This should be determined by a technical indicator or price action. The reason why a short and long target works so well, in my opinion, is because it recognizes the fact that sometimes our currency will be stuck in a grind and there's not much momentum or movement. Other times, the moves can be big, fast, and generous. So having a short and long target allows you to win in both cases because you'll be moving to break even when the short target is hit. In other words, if the trade continues to move in your favor, wonderful. Go for the long target. If it exhausts and goes back to break even, no big deal because you banked money in the first half of your position and it's time to move on to the next trade. There are many different exit strategies. You can simply set a pip target for every trade, which I like to do when I trade ZIP with my BK Forex members, and I actually recommend this for the first half of the position. The second half is where you can get creative. You can keep the hard target after you move to break even, and moving to break even is very, very important part of the process. You can trail by the technical indicator. I like the 20 SMA in the same time frame that you're trading. You can also use price, like the 2 or 3 bar high and low in this chart here. With a 3 bar high and low, you're staying in a short trade until the high of the last 3 candles is broken, suggesting a possible change in trend. I have met so many traders over the years who have complained about profitable trades taking a turn for the worse and stopping them out. It happens to everyone. And that's why I'm such a big advocate of short and long targets, especially for day traders. That way you can make money when the moves are small and milk the trade for profits when the trends really get going. I hope these tips give you something to think about and help you become a better trader. And I encourage you to check us out at bkforex.com.